welcome and good afternoon, everybody. My name is Kyan, like the pepper. So this is our first of the two sessions that we'll be doing today. I've brought together, just so for people to know, this microphone is for the video. I have not had many beers. It's for the video. It's not meant for the room. So I've brought together a team of experts today for you guys. This first session is gonna be geared towards newer businesses, not just breweries, but yeah, newer businesses, younger businesses in the first, maybe 3-4 years of your business stage. I'm joined today by Andrew from Newport Accounting Group. And then I also have with me Lyna from our RBC Trade Finance Department. And last but not least, Jonathan from ADP Canada. Okay. Right. So our agenda today, we're going to cover the Canada Small Business Financing Program. Show of hands, who's heard of this program? Oh, that's great. Perfect. So we're going to go into a little bit more of the nitty-gritty details of it, kind of cover how to apply for it, what we look at, how much you can get, what it covers, all that stuff. Then we're going to go into business plans, right? How to create your business plan, what do you need on it, how to set up proper accounting, working with your accountant, and we're going to touch on some SR&ED tax credits as well. And then my colleague Lyna will step in to talk about importing equipment. That's very common now. We have a lot of our breweries, having their equipment supplied from Asia or overseas. So we're going to talk about things you want to think about before you do that, and tips on working with international suppliers. And last but not least, Jonathan will talk to you guys about payroll basics. So maybe the top 5-6 mistakes that we find that entrepreneurs make when they start their own business in terms of payroll. Okay. Oh, there's me. Perfect. So before I go into kind of the CSP FL and kind of the program details, one of the things we find at the bank when we have new entrepreneurs, I'm not in the camera. It's really weird holding a microphone. It doesn't echo back. One of the things we find at the bank that we get a lot of questions about is kind of what type of financing products for what purpose. So unlike personal financing, you guys can go get a personal line of credit. You can use it for whatever. You can buy a car. You can buy things for your kids. It doesn't matter. It's for miscellaneous use. When it comes to business financing, it's very purpose specific. So we match your financing type to what asset you're financing. So for example, intangible assets, that would be your R&D cost, maybe your supplies, inventory, well, not so much, but your supplies and such. So that would be done by equity, right? Because those are not generating cash flow yet. When it comes to your current assets, so that would be your receivables, your inventory, a little bit of your working capital. That's where we would set up an operating line, so like a line of credit, right? So that would be to bridge the gap. When you have your inventory, you've bought ingredients for that, and it's being held up, and it's not yet generated a sale. So that's what the operating line would be for. And last but not least, we would set up term financing for your long-term assets. So that would be your equipment, your leaseholds. That's really important because we want to match the type of financing to the debt. So that way your debt for that asset will reduce as the financing is paid down. Okay. Yeah. We do, especially in a newer stage of a business, right? We do rely a bit on personal guarantee. So yeah, we would kind of look at it to see, do you have any shortfall funds? If you would need to inject any money in down the road, because we all know the first few years of the business you may not generate much profit, right? Do you have enough to kind of inject into the company? So yes, we do. Yeah. So now that we've gone that, we're going to talk about the Canada Small Business Financing Loan. Who here actually worked with it, or have you guys just heard of? You've worked with it? Okay, awesome. I'm super passionate about this program. I've worked with this program for about 4 years, and we've been able to help many businesses start up or expand with this program where they normally would not qualify for traditional bank financing. So it's a really amazing program. The program was set up by Industry Canada, right? It's administered through the Canada Small Business Financing Act. So the act was set up with a few main objectives in mind. So the first one is to provide easier access to financing for newer businesses, so startups, younger businesses, etc. But it's also there to help established businesses modernize and expand, right? And last but not least, job creation, right? So the government, it is a federal government administered program, so job creation is very important. And of course, if we can help small businesses, that would in turn create economic growth. So who can be eligible for this business? Essentially, any operating business in Canada with a top line sales under 10 million. Right? So it's not just for small businesses, I would say small to medium businesses will qualify. Right? So what can the loan be used to finance? That's the most common question. So very easy, three types of assets. So equipment, so that would include your tanks, brew house, your canning line, your cooler, etc. Leasehold improvements, so build out cost for your business. And last but not least, the owner-occupied business premise, right? So if you're buying a warehouse for storage, or you're buying the premise you're working on or the next door to expand, so that would all qualify under this program. What this program cannot cover is inventory, working capital, your marketing expenses, a lot of the soft startup costs, it won't cover. So it's very specific. So, building permits, we can't use under leasehold improvements. Those are not covered. Franchise fees, your own labor, we've had people try to charge us for that. So no, that's not covered under leasehold improvements. More common than you think. Okay. And how much can you borrow? So when we look at equipment and leasehold, we do look at it together. So combined together, you guys can access up to 350,000, right? That's the max for equipment and leaseholds. And if you're looking to purchase property for your business, up to $1 million. Right? And again, we'll have a question answer period. So I know this is a lot of details. So you can chat with us after. So what is the maximum loan to value? So that's very important. So for equipment and leaseholds, about 90 to 100%. So if your bill for that equipment is 100,000, then we can finance about 90,000 of it. Yeah, exactly. So if your build out cost is 100,000, we can potentially finance up to the full 100,000 for you. And amortization, that's the maximum that we can spread the loan payments out over, right? And that it's dependent on your lease agreement. So if you have a lease for your space for only 2 years with no option to renew, then that's all we can spread your loan payments over is 2 years. Most likely you will have a 5-year lease with an option of another 5 year to renew, then we can do the full 10 years. Okay. Rates for the loan, it's set for all. I should note, this program is accessible through any of the Canadian banking institutions, right? So you should be able to walk into your local branch, your local bank, and be able to access this program. Some institutions may be more familiar with the loan than others, depending on if they've worked with it before. So the rates, most common is our variable rate option. So it's prime plus 3, right? So the variable rate option will allow you to prepay or pay off the entire loan without any penalties. And then there's also a fixed rate option. Okay. Fees that you guys need to know. So 2% of the total loan amount that you borrow will be charged onto the total loan amount. So you can either pay the 2% separately, or we can include it as part of your whole borrowing package. So that fee is actually paid to the federal government. Okay. The other annual administration fee, 1.25%, that's already embedded in this rate here. So it's not on top of that. And again, those two fees are remitted to the federal government. And some things you want to think of, depending on your financial institution, there might be an application fee, loan documentation fee, and security registration fees. I think some cool funding facts I think is good to go over. So the program, what's neat about it is once you're approved for the loan, you do have 12 months to pull from it. So if you're approved for 300,000, the build out phase will probably take a good 9-10 months, you have 9-10 months to use that full loan amount. You don't have to draw it right on the spot. So a lot of our clients may wait, closer to the end. If you have equity to pay for a lot of the build out yourself, you pay upfront first and then get reimbursed for this. So you do have 12 months. Invoices can't be older than 180 days. So if you've already started your build out, you've bought your equipment and you realize, you know what, I actually do need funding, you can come to us. As long as the invoices are not older than 6 months from the date that we get you approved, we can actually set up the loan facility and you can backdate your invoices. We can pay the payments directly either to the vendor, or if you've already paid them yourself, we'll reimburse into your account. If you don't draw on the full limit, so a lot of our, especially for breweries, because the cost is quite large, we do approve it for the full 350. So you get charged 2% of the fee. If after the 12-month period, if you guys don't end up pulling the full 350, then the government does reimburse a prorated amount of the 2% back, guys. And last but not least, equipment must be on Canadian soil before funds are advanced. So if you're importing equipment, that's totally fine, but it needs to land here, and we have to come out and make sure that it's on Canadian soil on your business premise before we advance any funds. So that means most likely you have to pay for it in advance. Okay. So here's an example that we've kind of set up, a brewery example. Again, this program can apply to any business, right? So if you're doing a brewery, for example, startup costs around 1.4 million. You will have 450,000 in leaseholds, probably about 600,000 in equipment. You've got furniture, smaller. So this is how we calculate how much your startup costs are. Right? Yeah, it's expensive. Right, so all this adds up, it's about 1.4. And then we would kind of look at where are you getting these funds. So maybe 350,000 will come from the CSP FL program. 250,000 perhaps from BDC or another secondary financing option. And then the owners itself would inject 800,000. Okay. So why this is important is because we don't just say, here's 350,000. We actually look at the total cost, and we would need to know how much of the total cost is financed, right? So if you're doing maybe an ice cream shop and the total cost is only 400,000, probably can't get the full 350, right? Because then we're financing up to 90%. So we do look for the financing to be below 65%, more or less, from your total cost. Okay. So why the CSPFL? Why do we recommend it? So there are 3 main advantages for the CSPFL. The first is a 25% personal guarantee. So you had a question about the personal guarantee, right? So a lot of times especially again, when the business is fairly young, we do rely on the ownership providing 100% personal guarantee on any business lending that the borrowings that the business has, right? So if you're borrowing 100,000, the owners are responsible for the full 100,000. But under this program, because the government does back it, your personal guarantee is reduced to 25%. And the government covers 85% for the bank. So there is about 10% overlap for administration cost. So, especially for startup businesses, right? So if something were to occur and the business doesn't work out, you're only liable for 25. So this is why we highly recommend this for newer businesses. It reduces your personal risk as well. Another advantage of this program, we can finance up to 100%. Of course, it depends on your total project cost. But for a brewery, usually we can do 100% of the equipment costs or the leasehold costs. Traditionally, for financing, usually we would ask you to put 25% down payment, more or less, for an equipment, right? So if you're buying, a silo for 50,000, you're gonna have to put 25% of that, and we finance 75. But with this program, we can do up to 100. And the last one is amortization. So many times when you get traditional financing, we would amortize equipment or leaseholds up to about 7 years. But this one we can do up to 10. Again, providing your lease agreement with your landlord supports that. So I think the first one is something to really pay attention to, especially for newer businesses. Okay. And so this is kind of a sample credit. What type of credit would a sample brewery have, right? A start brewery, we would set up credit cards, right, to run your day-to-day expenses. We'll set up your operating line for your inventory coverages, and then term financing, which could be the CSP FL, right, for your equipment and leaseholds. So what kind of documentation would we need if you guys were interested in a CSP FL loan? So keep in mind there will be a lot of documentation you need to prep up front. Again, and it's also a government program, so vice versa, there will be a lot of documentation to sign as well. So business plan, very important, and Andrew will talk about it shortly, but we would need a viable business plan with 12 to 24 months income projections, right? We need to know how much are you guys going to make every month? What are the expenses? How much do you have left over to pay for your debt, essentially? We need to know your total project cost. That's very important. It doesn't need to be exact, but we do need to know, a good estimate of how much everything is going to cost. Because we also want to make sure that you have enough funds to finish the project because, well, if you don't have an operating business, nobody's going to pay off the loan, right? So it's really important for us to know how much it's going to cost, where are the funds coming from. Lease agreement, right? That will help us determine how long we can stretch the payments over. We will need to know your company. So who's borrowing? Who owns the company, the structure, everything. Personal statement of affairs, so completion of your net worth statement. Proof of injection, so if the owners are injecting the remaining of what we're financing, right? Where's that coming from? Is that in the bank account? Is that currently in your savings? We need to know, do you have that money to inject, right? And this is just for breweries, but we would need the manufacturer's license or approval in principle anyways, before we can release any funds. Perfect. Yeah, so I know there's a lot of details. So we'll have a question and answer period later, and of course we'll be downstairs in the RBC booth. So please feel free to come down and ask any questions you may have. Okay.
So my name is Andrew, and I'm one of the partners at the Newport Group, Chartered Accountants. We've been working with craft breweries for 4 or 5 years now. First with some more established breweries, and then working with the RBC team here, we've put together projections and helped get financing for new startup breweries. So we're getting pretty familiar with that. But put together a few things geared to sort of the year before you might open a brewery to the first 2-3 years. Kind of what do we need to know, and how can your CPA help in that regard? One of the first things we can do, like Kyan mentioned, we can assist you to put down together projections and business plan, so we can help you get a loan. We can help you structure the business, work with your lawyer probably there too, and apply for some things like EBC tax incentives. I'll get in that, but we can help attract investors. That's a part of we saw that $800,000 on her shareholder equity. So that's where we're going to get that $800,000 is maybe through this program. Then after that, we can start to work together to set up your accounting system properly and track our business. How are we doing on a month-to-month basis? And then the reason we're doing that is because we want to make decisions based on those results in real time. We don't want to find out how we did last year 6 months later and then try to make decisions when it's far too late. I mean, one of the last things we'll touch on is just the SR&ED credit. So that's research and development tax credits. There's a seminar on it in more detail. I'll just touch on what I think is important for you guys to know. So starting off, we've worked with a few projections with the bank. And I think one of the things that maybe you guys aren't familiar with about a projection is that the most important thing is for it to be a plausible and realistic representation of the first few years. We've had some opportunities to work with clients where, hey, if we put in a whole bunch of revenue and we're going to project that we're going to make $3 million after 3 years, that should get us the loan. And actually, that's not going to be the case. What their credit team is looking for is something that's going to very realistically forecast how are we going to take that money that we start up with and transition to breaking even each month, breaking even over a whole year, and eventually showing a profit. One of the things that is going to, obviously, we're going to charge you some fees to help put that together. And so if we're going to charge you to put together a projection, one of the things that we'd like to help you guys do is get some value out of that. And if we're going to put a projection, typically said 12 to 24 months is what Kyan said. If you're going to forecast your financial statements every month for a 24-month period, wouldn't it be great if we could have financial results in real time that each month we could compare to that projection, see, are we on target? There's also going to be financial ratios. I know Mike Sally is going to talk about that in the next hour. These are going to be covenants of your loan, and we're going to have to make sure that we maintain things like a current ratio or a debt to equity ratio. And we'd like to help you set up your accounting so that you can look at that every month and see, are we on track? Are we trending away from being on within our loans? That type of thing. The other thing that I mentioned too is, so if we're going to attract investors. What's one of the best ways to get investors to want to get into our business? This is one of the things, as more breweries open up, there's less and less of this investment out there. So the competition to be able to get investors for a new startup brewery might come down to something like this. So this is a provincial. Is anybody familiar with the eligible business corporation tax credit? Okay, so a few people. So what that is that an investor can invest up to $200,000 in your brewery. They get shares, which they must own for 5 years, but they get on their first tax return a 30% provincial tax credit refunded them, even if they didn't have taxes to refund. So someone who, and I've seen this with breweries where a couple investors have come in for the full 200,000, the first personal tax return we file for them, they get a $60,000 refund. That's a pretty attractive reason to be able to invest, have $200,000 worth of shares, which only cost you $140,000. One of the things, if we're over $500,000 worth of investment in our corporation, and I think Cayenne's had about 800,000 in that typical setup. There's something called a review engagement, and that's what it's kind of like a light audit. It's probably the best way to describe it in short. But that's also something that your CPA can help you with, and that actually some chartered accountants don't even do those engagements. So that's something that you want to be talking to your accountant about if that applies to you. And so I have a quote here: "You can't manage what you don't measure," and that's really just getting into talking about setting up your accounting correctly so that we can measure our results on a monthly basis and compare them to that projection that we had at the very beginning in order to get our loan. So one of the things I talk about a little bit is the difference between internal and external accounting. We have management software. I don't know, do a lot of you guys use Ecos? Brew Ninja, some of these you're probably familiar with. I actually went to the Ecos training seminar yesterday and talked to some of the guys who are developing that. Basically what we want to do is I want to help you set everything up so that we can have our production staff, enter our purchasing staff enter the cost of our materials. Our production staff then is going to take those costs and enter them into the batches that we actually have running, so that information is there for our sales team when we go and sell. How much was the cost of each sale, and have that information available to us every single month so that we can tell, is our tap room making all the money? Probably that's the most profitable center of your business. But how are we doing with what we're selling to the liquor stores and in the restaurants, etc.? And so the other thing I just wanted to talk about is sort of dashboard style reporting. What is that? We can set things up, like I said, QuickBooks Online, links with Ecos, or whatever software you might be using. We want to set things up so that we can look at the KPIs. What are the crucial things that tell you whether your business is profitable during the process? And also, what are the ratios that the RBC team here is going to look at year end? And let's keep an eye on those throughout the year. And the last thing, just making decisions right away before the cash is gone. So cash is sort of key here. We don't want to have periods of this year where we suddenly run out of cash. That's never a good time to go to the bank and ask for more. They want to see you increase your lines of credit and that type of thing at a time when we're doing well. So one of the things, this is sort of a separate topic, but staying on the theme of making sure that we have cash in the business, here's an opportunity to get a little bit of cash back. And I think last year at this conference, there seemed to be a lot of hesitancy around SR&ED credits. I watched the seminar this morning, and they didn't really seem to have any examples of breweries that have successfully done this. I can tell you, in at least one case, I have a brewery who, in their first 2 years, got about $15,000 to $18,000 back each year. So if we're going through a tough months, we're starting to get into February, March, not a lot of sunshine in this city. You might have cash flow problems. It'd be a great thing if we had a refund coming for maybe 15 grand. That might be the difference. Another thing to consider with cash like this, one of the people that's the last people to get paid in a brewery is probably the owner. Cash is tight. We don't take our salary, our draw, or that type of thing. $15,000 could be $15,000 out of your pocket at the end of the year. I'm just going to jump back to my original slide. One of the things that was spoken about at the keynote this morning, I don't know how many of you were there all, but was just, I think the phrase they said was to lean on our business side of our business, work with professionals. What's going to happen, and what's one of the most common questions that we get is, I think everyone's familiar with the question of, are we approaching a bubble? Is the market saturated? How will we know when that is going to take place? We're not there yet, and that seems to be the answer. But how will we know when that is? And it's probably what we're going to see is businesses starting to go out of business. It might be a brewery with great beer, and oh wow, they had to close up shop. Why would that be? What it will be is the businesses that don't run their business the best. It's going to be those that ran out of cash during a month and couldn't pay their bills. The best way to be able to avoid that is to have that monthly reporting that's going to forecast our cash flows for the next year and a half, and we're going to be able to not have any of those issues. Thanks. So that's enough for us, but I'll be around for the next hour as well. If anyone has any questions, come chat with me, grab a business card. Happy to talk about it more.
So who here has purchased equipment or is thinking of purchasing equipment offshore supplies? Okay. Who has actually got their equipment? No problem. You pay cash. Oh, I see a shaking. Okay, so no problem. So I guess you pay deposits upfront and then balance upon shipment, showing you some piece of paper, and then you have to pay, right? So I think this is the best case scenario that you purchase the equipment offshore. It arrives on time. Everything's okay. You pay cash. Cash did not disappear. The supplier did not disappear. So that's the best case scenario. And we have heard stories from customers, may not be in your industry, but we have heard stories from customers that they source their equipment offshore. They pay the deposit. I think it's 30% typical, or 50%. The supplier is, making equipment. And all of a sudden, there's an email that came up and said, we changed our bank. You need to send this balance 70% or 50%, whatever percent, to my other bank. So our customer actually remit the funds to that new bank without actually checking, because the email address is legit. And so this is an email scam. So they send the wire payment, and the supplier is like, where's my money? I can't ship you the equipment without my money. And sure enough, supplier's email was hacked, and the client is out of pocket for that. In that case, it was 70%. And the supplier says, I did not get it. I'm not going to ship you my equipment. So what happened? Client's out of pocket for that 70%. They have to send out 70% before they get the equipment. So that's one case where things could go wrong. And this is happening very frequently. That's an email scan. I'm sure a lot of you receive email scan saying now, okay, from supplier, my account has been changed and things like that. Sure you have, I have, right? So that's one scenario. The other scenario, there's a lot of other risks that you need to consider when you are purchasing equipment or supplies from suppliers overseas. If you're buying locally, I can drive to maybe Chilliwack or Mission and say, okay, I want to see my equipment, how you're making it. I want to check out my supply. You can do that. Make a phone call, same time zone, everything is fine. But let's say you're buying from China. So they are 15 hours ahead, I think. So there's a time difference, there's a language difference. The country, I'm not familiar with country, I'm China. I'm not sure what their law is. They also have a foreign currency control. So here's some of the risks that you have to consider. Performance risk, supplier, you cannot just be like, driving to Chilliwack or Mission, checking on the supplier. I'm sure the supplier that you're dealing with may be reputable, but what if you find somebody tell you, oh, this supplier is really good, it's a tiny little one, don't even know whether they exist. You can ask, if you want to check out somebody overseas, you can actually ask a Canadian Trade Commissioner. We do have embassies, overseas. You can ask them to check it out and see, this is the address. Can you actually check out for me? There's actually physical premises there. You can use Google Maps. I think Google Maps will show you where they store from, facility or something like that, right? So do your due diligence, sure the equipment that you order is when you receive it, it's what you order. Documentary risk, again, different languages, there's different documentation practices. So you need to make sure that the documents that they can produce the documents and that so that you can actually clear custom when it arrives in Canada. Again, country political risk, like depending on who you're sourcing the equipment or supply from, it's definitely different from Canada or US. You need to be aware that you're not dealing with or buying from a sanctioned country or even restricted country. So please check with your bank before you purchase because you don't want to be associated with a sanctioned entity. You'll be on the blacklist for a while. So transfer risk, this is more from the other side, is whether you can get the money outside of the country, foreign exchange. So I'm sure when you purchase, it's mostly US dollars and you have to convert from Canadian. So just be aware that if it's a large amount, you may want to talk to your bank about hedging the currency. Okay. So again, like I mentioned, I think most of you pay 30% deposit or 50% deposit and balance on upon shipment or showing you a piece of paper. So there are other options available to you than just paying cash upfront. So the previous scenario is like you're paying 100% out of pocket before you actually see your equipment. Is that safe? Probably not. Can you go back and negotiate? Yes, for sure. They expect you to negotiate. They will always come back with the terms that's most favorable to them. They are expecting you to go back and negotiate. And what I find is we Canadians tend to be very nice. Whatever they tell us, we say, okay, and we try to make it happen. Let's say if you're buying from China, it's very, very often that they will accept a letter of credit as a payment option. And I will go into the benefit of using a letter of credit. So what I want to show here is you are the buyer. The buyer is on that side. So cash in advance. That's why I just talked about 30%, 70%, most risk for you because the supplier has 100%. They don't have to ship, right? On the other hand, open account is, you get a piece of equipment. You don't have to pay for, say, 30 days or 90 days. It's more advantageous to you, but to the supplier, most risky, right? I'm sure you want here, they want here, and then there's somewhere in between, right? So there are some trade instruments, and that's been around for centuries. It has not changed, and why? Because it works, right? So letter of credit is what I mentioned is is used very common in Asia. It's a promise by the banks or your bank, buyer's bank, to pay the supplier if they can ship the product, equipment, and present certain documentation on time. Then they are guaranteed that they will be paid by the bank, not you, but the bank. So the payment risk to them is actually shifting from the buyer to the bank. So there's more assurance for them. So it's like kind of right in the middle. So mitigating the risk for you and mitigating the risk for the supplier. And there's two other trade instruments there. One is a guarantee. So guarantee is a bank guaranteeing the performance or payment of the applicant. In this case, actually the seller. We'll talk about that. Document GLC doesn't really apply here, but that there's another trade instrument that can facilitate international transaction. So just so that you know that there's more to the cash advance and open account, there's other options of payment. So I mentioned that. So equipment purchase, the risk, again, you like I said, 30% deposit and 70% upon shipment. So again, that's 100% prepayment before the equipment arrives. So very risky for you. Term loans, you may want financing from the banks to finance the equipment, term loans or leasing. So you usually, I guess, you would have to draw down on your line of credit. You pay interest on that to purchase that piece of equipment, which you could have used for other purposes. And the seller, again, they are not guaranteed at the 100%. They only receive a 30% deposit to start the project or the equipment. What about the 70%? What if you just walk away, or assuming that the buyer went bankrupt? The supplier, they also have a risk in doing the 30 and 70 in the sense that they don't have assurance of that 70. Usually when you pay a 30%, yes, chances are the buyer is going to complete a contract and pay the 70. But what if the buyer went bankrupt or went into hiding, something happened to them? They are stuck with a piece of equipment. If it's customized, they won't be able to sell to somebody, so they are stuck with that piece of equipment, right? So it's risky to the supplier as well. So there is some alternative, like mentioned, to than just using cash, is the 30% or the 50% deposit that you actually have to pay. You can request an advance payment guarantee from your supplier. Like if it's the first time you're dealing with them, you don't know them, they don't know you. Of course, they want some deposit. Again, what happens if you pay the deposit? The supplier doesn't complete a contract. They don't ship you the equipment. You can go back and ask them for advance payment guarantee. So what is advance payment guarantee? It's issued by the supplier's bank to you to guarantee the deposit that you just paid, saying that if their customer, the supplier, does not complete the equipment and do not deliver, you have the right to claim on that bank guarantee, advance payment guarantee, and you'll get your deposit back, right? It is very common, and if the piece of equipment is expensive, let's say 300,000, 30%, it's almost close to 100,000, right? It's a lot of money to me. I'm not sure whether to you, but to me, 100,000 is a lot of money. Oh my God. So again, definitely if they ask you to pay a deposit, you say, well, I don't know you. I want a guarantee from your bank, right? What's the worst case scenario? They say no, but then they may say, okay, instead of 30%, I just want 20%, right? So always go back and negotiate. So ask for advance payment guarantee to cover your deposit, and then tell the supplier that I'm going to issue a letter of credit for 100% of the contract. Benefit to you is your guarantee payment from my bank for 100%. I want this advance payment guarantee. And then to you is you don't pay anything until the supplier has actually put the equipment on the boat, assuming it's coming by boat, and then they have presented all the shipping documents, including bill of lading, commercial invoice, packing list, inspection, whatever you require to clear custom here, to their bank, and their bank has to send it to us. So we have evidence that a piece of equipment has been put on a vessel. So until then, we don't make any payment, right? So that reduces your risk as well. So again, there's a three-party, and then what they need. Again, they want assurance. Everybody wants assurance. So here's how it's an example to structure a letter of credit. So assuming that the supplier still needs 30%. So we can put the 30% in. So the LC letter of credit is 100% of the equipment price. So first 30% payment is against a copy of invoice, and advance payment guarantee. So we will require the supplier to present a bank guarantee to cover the deposit in case they don't deliver. So the next 60% is upon shipping documents, which is fairly common. 10%, I think a lot of people forget about keeping the last 10% as withhold, like the hold, because you want to make sure the equipment that you receive actually works, right? So you can definitely negotiate 10%, last 10% as a holdback until a final acceptance certificate is issued by you. This is very common, right? So this is an example of how we can structure a purchase using letter of credit. So again, benefits, you don't have to use your line of credit. You don't pay interest on the line of credit. You just pay the fee for the letter of credit, and I will do a comparison shortly. Again, lower cost for you, but if you can borrow from your parents or friends, zero cost. But there's, that emotional cost. Mom and pop is like, come on Friday, we're having a dinner. I guess you have to go. So that's the type of cost that you have to pay. So again, financing 100%, letter of credit for 100% of equipment purchase. We can turn that into a lease. And again, if you can issue a letter of credit, that means you are credit worthy, because the bank just doesn't issue an LC for anybody, right? So to the supplier, they'll be like, oh, okay, you can get a letter of credit. Then, you're a good company. And it turns around that they can take the letter of credit to their bank and they can get financing that way. And it's 100%, right? So versus just the deposit and they have to fund it themselves, with a letter of credit, they might be able to get financing from their bank, right? Again, yeah, I think I mentioned that. So here's a cost example. Let's say a US dollar, 100,000 piece of equipment. Assuming they pay, they can ship within 90 days after you order. So I'm using an interest rate of 7% for US dollar. The cost for the 90%, for 90 days is about $1,726. So if it's 5%, I'm not sure, 7% might be a little bit high, but let's say 5%. 5% is still about $1,300 for you to use your line of credit and pay interest for that 90 days. So that's a cost to borrow. Let's say if we do a lot of credit at site just means that when the supplier ships the goods and they present documents, so when the documents arrives here, we have to pay. So that's a site LC. And here is the cost for issuing a lot of credits. It's about $625 versus the $1,700. So let's say if you're able to negotiate with the supplier and said, okay, I will pay you 30 days after you ship, so you will have access to the equipment and things like that. So it's a 30 days LC, and the cost just goes up slightly to about $700. Still cheaper than if you borrow from the line of credit and pay the supplier, right? And then you have the control, because with a line of credit, you actually don't pay anything until there's evidence that the goods are actually on the ship, right? So again, benefit, no payment until there's evidence of shipment, lower cost. And with a lot of credit, I'm not sure whether those people that I mentioned they had purchased from the supplier, were there delay in shipment? Yeah, with a lot of credit, there's a later shipment date. If it's past the later shipment date, it's a discrepancy. So it will be up to you to accept. Then you can kind of negotiate deduction, whatever. So with a lot of credit, it actually ensures delivery of equipment on time. There might be delay again, but like I said, if there's delay, then you can negotiate some kind of price reduction. Right. So again, here's just a comparison of the cost. So it's again, it's an option for you to consider, right? You don't have to use it, but it is an option, and there's benefits for all the parties involved.
Yeah. So this is just some quick stats. I'll just go through it really quickly. How many Canadian employees that we pay? We pay about 1 in 4 Canadians right now in the private sector. Our average client size is actually 2 to 5. Misconception between with a lot of clients I meet with, they think bigger clients, but that's not the case. Currently, we support around 45 brewery clients across Canada. I think the last count was around 20 in BC. In an audit, CRA usually requires records for about 6 years. There's about 196 payroll laws. The average CRA fine for payroll when owners or payroll practitioners make a mistake is around $5,000. Right. So just a standard basic payroll process. Input the hours or submit them or send them to a payroll processor or an accountant. Do the calculations. Pay the employees, produce the pay slips, remit to the CRA, and also generate the T4s and the record employments, right? So as you can see, it's a headache, right? So, how does ADP help? We help business owners like yourselves save time, cut cost, and reduce risk, right? We usually take on 5 of the 6 main payroll tasks. But I wanted to, it's on the slide, but I wanted to mention, there's 10 audit adjustments by the CRA that we typically see. This is from the Canadian Payroll Association, but most of the mistakes and stuff like that, when it comes to, it looks basic, but most of the mistakes, when they do happen, they usually do with the payment part, right? So there's a lot of issues around, T4As. Yeah, okay. So around T4s, how to expense automobile payments, so mileage, the vehicle allowance, parking benefits, and that sort of thing. So that's just 4 out of the 10, right? So usually with that, I consult clients, right? They always come to me, and we can usually figure that out before we set up a potential client on a payroll system, right? So another little bit that we support our clients with is a lot of HR. We're seeing a lot of value there from clients, right? We produce like offer letters, termination documents, welcome letters, right? Of course, we also create the employee handbooks nowadays as well for our clients. We also help with recruiting, and we also have a help desk. So if anyone has any questions, they can just call into a phone line, right? Another thing that might be, relatable to breweries, I find, is, you guys have a lot of hourly staff probably in the manufacturing production areas. So, we also help with like time systems, track employee hours, scheduling, vacation, sick days, time off requests, statutory holidays, overtime, and statutory calculations as well. I'll just give you like a 1-minute overview of basically what an automation product might look like for your business, right? This is our newest product. It's Workforce Now on the Go. You can produce basically payroll from any mobile device. You could be vacationing in Mexico and having to do payroll. You just need a phone, a tablet, or a computer, right? It's also integrated with some basic time. So if you enter in the time for the employees that work on every day of the week, we'll do your automatic stat holiday and vacation calculations. That's basically it. Thank you, guys.